Hey there, awesome accounting student. Mark Franke here. This video is on Chapter 6, Accounting 100, the closing process and the post-closing trial balance. So let's talk for a second about why companies need to close their books and what the purpose is at the end of each year. This is a process that happens every single year. Why do they do it? Well, we want to be able to compare from year to year to year on the income statement, sales and expenses. So what that means is if we zero everything out at the end of the year, and again, this only happens at the end of every fiscal year. Companies use fiscal years differently. Some use a calendar year, but some don't. Most of the big retailers, Walmart, Target, Costco, they don't want to close their year at December 31 because that's the busiest time of the year for them. It's during the holidays. At that point, people are returning stuff, and so they wait until the end of January, the end of February, and do it then. Most school districts close their year on June 30th because that's an academic year. Apple computers close their year on September the 30th. But anyway, the point is, at the end of the year, we zero out the revenue accounts, we zero out the expense accounts, and we zero out, in this case, the drawing account. In a corporation, it would be dividends, but in a sole proprietor, the drawing account. We zero them out. We start a new year fresh with those accounts at zero, and then we can compare. Then we can say, hey, in 2016, here's our sales, 17, 18, 19. We can compare them and see what the trend is in the business. Okay, so this is a 4-step process. The first step is to close the revenue accounts, where we have this account called the income summary. It's just a very temporary account. We open it up and then we close it in this 4-step process. Second step is to close the expense accounts into the income summary. So now we have all the revenue is moved into the income summary, all the expenses are moved into the income summary. So when we close the income summary to the capital account, it is going to be equal to net income or a loss. If our expenses are more than our revenue, we could have a loss, and then we will be transferring the loss to the capital account. And then the last step is to close the drawing account to the capital account. The drawing account is always going to be a debit balance, so that debit is going to be pushed into the capital account, and it's going to make the capital account go down. And I'll show you how this works using problem 6.2b. In the problem, they have given you a worksheet, a completed worksheet for the Elegant Lawn, Nursery, and Landscaping. This is on, actually, the worksheet is on pages 190 and 191, and the problem is 6.2b on the middle of page 189. So we've got a completed worksheet here. Some things to note: that we have some adjustments. We had some supplies that got used. We had some advertising that expired, and we did some depreciation on the equipment. We don't have the calculations, but we do have the entries here in the adjustments column of the worksheet. And so we need to first journalize those entries. And I have done that on an adjusting journal entry page here. And it looks like this. Very simple. All we're doing is taking the adjustments that were on the worksheet and we're putting them into the general journal. We need to put them in the journal, and then they get posted to the ledger so that the ledger is up to date for all the adjustments that we did. In this case, there were 3. This is chapter 5. So hopefully this is something that you're familiar with. But our next step is then after we prepare the financial statements and everything is good, is to close the accounts. So what we're going to be doing, in effect, is taking these revenue and expense accounts and moving them into the capital account. And we're going to be taking this drawing account and moving it into the capital account. That's the purpose here. So we have temporary accounts, the drawing, fees income, supplies expense, advertising expense, depreciation expense, salaries expense, utility expense. All the revenue and expense accounts are temporary. We close them out every year, and this is what we're going to do for this year. So we've got a worksheet that has a journal. If you should be able to print this out, or you can use the Excel spreadsheet I provided. But this is all going to be at the end of the year, and this is 12/31/2020. And we will call this CE1 for closing entry 1. We will debit fees income, because fees income is a revenue account. It has a credit balance. We want it to go to 0. In order for it to go to 0, we have to debit that account. So where are we going to put it? We're going to put it in the income summary. And so in effect, what we've done with this entry is we have moved the credit out of fees income and into the income summary account. And this is to close the revenue account. That's step 1. Step 2, we want to close the expense accounts. We'll call this CE2, or closing entry 2. We're going to have one big debit for all of the expenses, and then we've got our each individual expense accounts. We have supplies expense, advertising expense, depreciation expense, salaries expense, and utilities expense. And this is to close the expense accounts. Uh-oh. Hold on. I put this to low. Okay, I fixed it. Okay. Now, right off of the worksheet, our salaries expense is $3,000, advertising expense is $1,200, depreciation expense is $1,500, salaries expense is $14,400, and utilities expense is $1,800. So when I total those up, $21,900. If I go back to the worksheet, I've got that total right here, $21,900. That's our expenses, so I know my entry is correct. So I'm going to go now to closing entry number 3, because, and let me keep this bigger so that you can see it better. Closing entry 3 is to close the income summary. So if we debit the income summary, because now we've got more credit than debit, and this is going to be the equivalent of net income, because we've taken all the revenue out and all the expenses out. And so in order to zero out the income summary, we debit the income summary account, and we're going to credit Karen Preston capital. In effect, the capital is going up because the company made a profit, net income, and we're moving it to the capital account. To close income summary to capital. And then our last or fourth entry is to close the drawing account. The drawing account has a debit balance. In order to close it, we're going to throw a credit at it. So we're going to debit Karen Preston capital. That's going to make capital go down. Makes sense because drawings make capital go down. And then Karen Preston drawing. And the drawing amount was $1,500. So that's our fourth and final closing entry. And this is to close the drawing to capital. Our 4 entries. So now, if we were to post to the general ledger, our balances in our trial balance would look like this. Cash, $32,400. That's right from the worksheet. Accounts receivable, $6,000. Supplies, $3,000. Prepaid advertising, $7,800. Equipment, $60,000. The accumulated depreciation is $1,500. Accounts payable is $9,000. And if we total these up, $109,200 is the total debits. And in order to balance out, I'm going to take that balance, subtract accounts payable and accumulated depreciation. In other words, I'm balancing out the trial balance so that it becomes, the capital account becomes $98,700. But we can prove that number by preparing a statement of owner's equity, because a statement of owner's equity should end up with the balance in the capital account that's accurate. So I'm going to take the beginning balance from the worksheet, $82,200. That's the balance in the capital account on the worksheet. Let's go back and take a look. Here it is, $82,200 right here. That's where I got it from. And we have net income, which is going to be the $24,900. I'm going to bring that over from my adjustments. We have the drawing, which I'm going to bring over as a negative amount from the adjustments, the closing entries. And then when I total it up, this is wrong. Okay, let's go back here. Made an error. See, this is a good reason why we do this. Because my fourth closing entry is not $1,500, it's $8,400. So let's do that. It should be $8,400. And that's a good thing to happen because I made a mistake and I found it and I fixed it. That's what accountants do. And our ending balance in the capital account after I fixed my error is $98,700. The trial balances, it only has the permanent accounts in it, which are the balance sheet accounts, and my statement of owner's equity tells me my balance is correct. So that's it. That's it for chapter 6. That's everything that we need for closing entries and the post-closing trial balance. Thanks for listening, and I'll see you again next time. Bye-bye.